For income-focused investors, global diversification is key. That includes exposure to the Asia-Pacific region, a market not typically known as a dividend hotspot. But don't write it off just yet. There are plenty of under-the-radar dividend stocks in Asia that check all the right boxes: strong track records, stable price action, and attractive yields. In this video, I'll walk you through 5 standout names with deep roots in Asia that deserve a closer look. APA Group, one of Australia's top energy infrastructure plays, runs a vast network of gas pipelines, power transmission lines, and renewables assets. The company was founded in 2000 as a spin-off from AGL Energy and is headquartered in Sydney. APA pays interim and final distributions, targeting 60 to 70% of free cash flow while signaling a focus on long-term payout stability. APA has raised its dividend 21 years in a row, a rare track record in any market. For fiscal year 25-26, management is guiding to a payout of 0.58 Australian dollars per share, marking another incremental bump. No red flags in the fundamentals, just classic infrastructure pricing behavior in a shifting rate environment. China Mobile is China's telecom giant, dominant in mobile, broadband, and digital services. Founded in Hong Kong in 1997, the company employs about 455,000 people. It's been trading in Hong Kong since 1997. The firm runs nationwide networks, serving both consumers and businesses. Roughly 69% is held by its state-owned parent, China Mobile Communications Group. China Mobile remains a steady dividend play. Like many Asian firms, it trimmed its payout in 2015 amid weaker earnings, but has raised it every year since, in Hong Kong dollar terms. In 2025, the story stays positive. The interim dividend was hiked by 5%, and the company is targeting a 73% payout ratio for the full year. China Mobile pays dividends twice annually, guided by earnings, free cash flow, and capital needs. Shares are up 70% over the past 5 years in Hong Kong, with no major red flags in the chart. The stock shows a clear upward trend, underpinned by stable fundamentals and solid investor sentiment. Japan Metropolitan Fund Investment Corporation, or short JMF, is a publicly traded Japanese real estate investment trust focused on urban properties. The company invests in retail, office, residential, and hotel assets located in prime areas across major metropolitan regions such as Tokyo, Osaka, and Nagoya. Its portfolio includes roughly 159 properties, with a total value exceeding 1.3 trillion yen. Over the past decade, JMF has built a solid track record as a reliable dividend payer, with distributions rising every year. As a REIT, the firm is required to return at least 90% of its distributable income to shareholders. Dividends are paid out twice a year. Like many Japanese companies, JMF provides forward guidance on its dividend outlook. For the current fiscal year, management expects dividend growth of approximately 3%. Despite market fluctuations, the stock has delivered a stable overall performance over the past 5 years, with no significant red flags emerging. QBE Insurance Group, based in Sydney, is a global insurance player with a footprint in over 25 countries and a focus on property, casualty, specialty, and reinsurance lines. The company, founded in 1973 via a three-way merger, employs about 13,000 people. After a decade of acquisition-fueled expansion, QBE saw profits peak in 2007, then fade almost uninterrupted through 2020. The drag? A complex, underperforming portfolio, high catastrophe losses, weak pricing in key segments, and soft investment returns. The stock followed suit, sliding for years, and dividends were cut in step with the earnings decline. But the tide turned in 2021. Under CEO Andrew Horton, QBE streamlined its operations, exited low-margin businesses, tightened underwriting, and leaned into core profit centers. Higher premiums, better risk selection, and rising interest rates all fed into the turnaround. Loss ratios stabilized, and so did investor confidence. For full year 2025, QBE is guiding to mid-single-digit premium growth, a combined operating ratio around 92.5%, and solid investment income. The focus, profitable growth and capital discipline. And here's what's grabbing attention. The interim dividend jumped 29% year over year to 31 cents per share. QBE pays dividends twice a year, typically in April and September, and the strong mid-year payout is raising expectations for a robust full-year return to shareholders. Parkway Life is a Singapore-listed real estate investment trust that specializes in owning and leasing healthcare-related properties. Established in 2007, the REIT has been trading publicly on the Singapore Exchange ever since. Its portfolio focuses on medical real estate, including hospitals, nursing homes, and even a pharmaceutical manufacturing and distribution facility. The trust's assets are primarily located in Singapore and Japan, but also in France and Malaysia. Most tenants are healthcare operators such as hospital groups and nursing home providers who sign long-term leases. As a REIT registered in Singapore, Parkway Life is required to distribute at least 90% of its taxable income to investors in order to maintain its tax-exempt status. Parkway typically pays distributions on a quarterly basis. The company has built a standout track record of reliability. It has increased its dividend every single year since its founding, without exception. That puts it in rare company among Asian stocks, offering both stability and consistent growth in investor returns. The stock price reflects the typical movements of a rate-sensitive company, but it doesn't signal any major issues. Thanks for watching. If you found this video helpful, don't forget to subscribe to the channel.